Good morning, everyone, and welcome to a webinar hosted together today with Coolset and Forbes Mazars. We're really excited to have everyone here today and welcome you to our webinar on Sustainability Reporting 2.0, Market Forces, ESG Risks, and the Next 5 Years. I think it's going to be a really interesting session. We got together, Paul, Denny, and I a while ago, and we're talking about the ESG landscape and how it's developing. And we're trying to come up with an idea of, okay, what do we want to communicate, considering our kind of fields of expertise, but also considering, the news headlines that we've been seeing in the last couple of months. Where is it going? What's happened in the past? And what can we see going forward? So I'm really excited for this webinar where we actually, not just focus on one topic, but bring together the expertise of the three of us. And that brings me to the quick introduction. So for those that don't know me, I'm Jasper. I'm one of the sustainability researchers here at Coolset and work on all of the ESG regulations that we have here. So Coolset is a ESG software platform. So we have software for CSRD, UDR, VSME, E-Taxonomy, EcoVadis, a lot of the acronyms out there we're working with. And also have a partnership going on with Forbes Mazars, which has also brought us here to this webinar today. Denny, do you want to introduce yourself?
Thanks, Jasper, for having us. Good morning, everyone. Denny Jansen, working at Forbes Mazars. Maybe a short introduction of Forbes Mazars. We're an international auditing, tax, and consulting firm, present in over 100 countries worldwide, with more than 40,000 people working in those domains. Myself, I'm director in sustainability consulting in the Netherlands, the Amsterdam office. Background as a CPA, so for me is more the connectivity of sustainability with the organization, strategy, and the finance component of it. Within Forbes Mazars, we have an international team on ESG specialists of 200 people within Europe and 350 people worldwide, working on several topics from environmental related focus topics to sustainable finance to the broader aspect of CSRD strategy and reporting and such. And happy to talk you through the market forces, ESG risks today. And then I'll give the floor to Paul.
Thank you. Good morning, everybody. So my name is Paul Jaspers. I'm also part of Forbes Mazars in the sustainability team of Denny. I'm an expert in sustainable finance. I'm a senior manager on that topic, and indeed, together with my global colleagues, work on sustainable finance related questions. And of course, when you talk about that, ESG regulation is very important. So that's also the reason why we're working together with Coolset. We have a lot of also impact directly that is being financed to real businesses. So climate risk is one of the key topics, of course, when financing various topics. So that's what we're going to talk about today, and hopefully we will bring you a very fruitful discussion and a very fruitful workshop. So hopefully we get a lot of good questions. Thank you.
Perfect. Yeah, so on the topic of questions, for all questions that come up, please put them in the questions section on the bottom right. So you'll see a chat function, which is where you can put any comments that you may have. And for questions, please put them in the question tab, because that also allows us to put them on the screen towards the end when we have the Q&A. So that's a bit of a kind of a note on that. Without further ado, let's get into the plan for today. So we're going to start with a bit of an introduction on why we're hosting this session and kind of what brings it together. Then we have a timeline on the ESG policies and the ESG landscape. And then we're really into the details. So we're going to talk about the 3 financial ESG pillars, which we've identified as being regulations, the physical effects, and the market. So the next steps will then be kind of the follow-up of that. So what can companies do, and how do we see it developing? And of course, any questions that come up that we may not have answered can be discussed during the Q&A today. So to start with a bit of an introduction, why are we working together? So we already mentioned it briefly, but as we see it, Coolset is empowering companies to measure, manage, and report sustainability with accessible software, and Forbes Mazars does that by advising organizations on regulatory readiness, double materiality, and assurance. And as we've seen in the last couple of months as well, it's a really fruitful partnership because it brings together different expertises and different kind of levels of support. So where we go from more of a software angle, Forbes Mazars really takes that people angle, and we see that works really well. So we're going forward with these topics today, and we're seeing that Coolset is really focused on regulations. Forvis Mazars as well, of course, but also brings kind of that physical risk element to the conversation. And together we see that market demands play into that kind of those pillars of the discussion. So today is really about bringing together those discussions and seeing also where it all comes from. So let's start with the introduction of a changing ESG landscape, as I briefly mentioned just now. So I'm sure for those that have already been working in ESG for a while, or at least for a year, will know that in the past year, a lot has happened, a lot has changed. And we're seeing that especially on the European scale, which is, of course, inspired also by non-European events, such as the US presidency, changing trade relationships, declining kind of competitiveness within the EU. There's a lot happening that is contributing to this. But what we're seeing in practice is that the omnibus proposals are rolling out at a rapid speed. So the Omnibus 1 proposal is set to exclude requirements for over 90% of in-scope companies for CSRD. CSRD is a massive reporting kind of framework that required over 50,000 companies in the EU to report on their ESG metrics. And now, under European kind of decision making, they've decided to really scope that down. So we're not sure yet about the final discussions. Yesterday, a new discussion was had in the European Parliament, where they said, well, we're having kind of fruitful discussions on the scoping, but the deadline of the 13th of October will likely not be reached at this rate. So yeah, something to follow, but also something to kind of keep in mind for the context of why today's session is being held. We also see that companies that were mid-report were abruptly halted all efforts. But what's interesting here is that while kind of the regulatory drive is slowing down, we're seeing that the private sector is taking on that responsibility. So what we're seeing is that while companies are saying, okay, well, the EU no longer requires us to do this, our suppliers are requiring us to do this. So we see that major companies are making ESG reporting mandatory for suppliers, but also banks, investors, and insurers give better rates for companies that map ESG. And this is something that we'll discuss in more detail in the slides to come. But this is a really interesting development that we have seen kind of shift in the last year. Also, what I wanted to share with you briefly is a survey that was launched by PwC in September, so a couple of days ago, where they kind of surveyed 496 companies across 40 countries, mainly based in Western Europe. And they revealed that 40% intend to delay reporting by 2 years, in line with the CSRD delays, but 40% will stay on the original timeline. What's really interesting here is that 60+% report increased resource investment or leadership time in reporting. 2/3 of reporters gain value beyond compliance, 28% say significant value, and over 50% saw pressure to provide sustainability data actually increase in the past year since the omnibus proposal was first tabled. So what we're seeing here is that far from kind of the discussion being over because the EU regulators are pushing it away, we're seeing that companies are actually seeing that discussion be more active than ever. And so that's, for several reasons, one being the market, one being kind of the market, the physical and transition risks related to ESG, which of course brings us to the discussion today once again. A brief overview of the ESG timeline. So once again, this is really brief, just to give you a bit of an idea that this is not something that started with the CSRD, for example, but has been around for quite a while. So in 2004, ESG was first coined as a term in the UN Global Compact, Who Cares Wins. And that kind of, kicked off this notion that ESG is an integrated feature that should be considered together with your financial reporting. So it's something that's very integrated in your company and not something that's separate from your company's future. Then in 2015, we've had the Paris Agreement, which I'm sure most of you will know. In this, 195 countries committed to limiting global warming to well below 2 degrees, ideally 1.5 degrees, therefore driving governments, investors, and companies to align reporting with climate targets. And that's kind of a very high level target. So of course, they didn't really delineate who and how to do it. Also, as it is non-binding, which is also why it got so many countries to align with it. But the how is essentially what we're seeing in the last couple of years, including the CSRD. So the CSRD made sustainability disclosures mandatory for around 50,000 companies and introduced the detailed European sustainability reporting standards, better known as ESRS by many people. And those are now also being simplified by the omnibus proposal. Good to keep in mind here is that they're being simplified, not removed. So, the scope is being narrowed, the standards are being simplified, but, we're still reporting. And that brings us to this year, where in February we saw the first ESG report being published. Sorry, the first delay omnibus proposal being revealed, and that brings us to the topic of today. Moving on, I have a quick poll here for you. So have your ESG reporting priorities changed in the last year? Let's launch the poll. So 4 options here. One is yes, we've become more ambitious. One is yes, we've gotten less ambitious. The third is our priorities haven't changed. And the fourth is we didn't report to begin with. So I'm really curious also in light of the PwC report, what people say here. So I'm seeing that 32% are saying our priorities haven't changed, which is interesting, considering that a lot has changed surrounding the reporting landscape. 23% say we've gotten less ambitious, 23% say we didn't report to begin with, and 21% say yes, we've become more ambitious. I think this is really in line with kind of the bigger picture that we're seeing. So overall, I think there is still a very steady course of companies reporting. Some are more ambitious, some are less, but overall kind of the general sentiment is that companies keep going forward. If it's not for regulations, it's for their suppliers or for investors or for banks. So that's really interesting to see. Now, let's get into the details of today's webinar, and starting with the introduction of the 3 pillars. So good to keep in mind here is that while, of course, we've taken this and inspired it from existing frameworks and existing kind of academic literature out there as well, we've identified these based on the conversations that we've had ourselves. So we've identified regulations, markets, and climate-related risks as the key drivers of corporate ESG reporting. And while, as mentioned now a couple of times, regulatory drivers are weakening, such as the omnibus and the delays, market and risk drivers are growing. Investors, banks, and customers continue to demand ESG data for decisions and contracts, and climate-related risks from climate change are already being priced into insurance and financing. And this is a really interesting story that Paul will also talk about more, as we hear that, insurance companies are now suddenly having these conversations about, well, we can insure you, but we also need to now consider the future risks of climate change, no longer just the risks that were always around. And that creates some interesting conversations. Also, we're seeing that these pillars explain why reporting isn't just compliance, it's also about competitiveness and resilience. And I think what we're seeing now is that while the conversation first was about regulations and complying, now suddenly the conversation is already there and it's moving on to the next stage, which is, okay, how can we move this into the kind of the core business that we're working with? So first section is on regulations, which will be led by me. So I want to give you just a bit of an overview of what we've seen. So as we've seen, the EU Omnibus right now narrows the CSRD scope by 90+% and simplifies ESRS by 66%. While we know that the ESRS will be simplified by 66%, the CSRD scope is still being discussed. So we got the last update yesterday. The EPP, the biggest party, the one that's also kind of calling the shots here, has, I think, mentioned the threshold of 1,750 employees for reporting, under which you don't have to report. The Socialists and Democrats, the second biggest party, want a threshold of 1,000 employees, which is in line with the original omnibus proposal. So we're seeing that this is not a done deal, but generally the scope is narrowing quite a bit. Also, many companies delayed into mandatory sustainability reporting via stop the clock, which was kind of something that ran adjacent to the omnibus proposal, but was a separate process in order to allow companies to actually stop reporting. So we're now seeing that the first reports for some waves are now pushed to 2028, but that doesn't stop the wave 1 reporters. So we're seeing a lot of the wave 1 reporters already publishing now. As far as I know, there's over 800 ESRS reports that have been audited as well. So that's really interesting to see that, while the EU regulators are slowing down and talking about how to fix this, companies are moving on. We're also seeing on EU taxonomy that this is being streamlined, with a materiality threshold now excluding sub 10% of financial flows. So if you have, for example, a small part of your finances that were previously aligned with, for example, a small part of the OPEX, that would have to be reported. Now that's not the case anymore. On the one hand, it simplifies reporting. On the other hand, it makes the sustainable financial flows less apparent. And for those that know CSDDD, it's kind of the human rights and the supply chain law that tracks how ethically correct your supply chain is. It's still in play, but the thresholds are very high. So the European Council has proposed a threshold of 1.5 billion euros of turnover and 5K plus employees, which makes it the scope very, very limited. So we're seeing that it's not being killed, but it is kind of being pushed to the fringes where only very few companies have to report on it. So why do regulations still matter, even as timelines shift? So we're seeing that the CSRD scope narrowed, but is still very much alive. And the reporting focus is also shifting to more kind of general scopes. ESRS data points are cut by 66%, but limited assurance remains required. And even if not required, we're seeing companies do this voluntarily because they want to signal to their investors that they have, that they don't just have a report that they put together with a small team, but that they actually have something that's ready to withstand the tests of assurance. EU taxonomy KPIs are streamlined, but will still be mandatory from 2025, 2026. And we're also seeing that non-compliance risks are still very much present. So while fines are a risk that's still there, these are less apparent, but right now we're seeing the reputational damages, loss of investor trust are bigger risks. And of course, also what Danny will talk about, what Paul will talk about, where we see that kind of the physical risks are also very much linked to kind of these non-compliance risks. So while it's not focused so much on non-compliance, but rather kind of the efforts of reporting on ESG, that also helps boardroom conversations steer towards how can you integrate the physical risks and mitigate those in the future. Because while now an investment of perhaps €500,000 might seem a lot, if your factory is flooded in a couple of years, that investment is going to be a lot higher. And of course, we're also seeing that while some regulations are being paused or slowed down, other regulations like the EUDR, the digital product passports, are coming up, with, of course, here a disclaimer that the EUDR is now also part of a delayed discussion, which has kicked off last week. So it is a turbulent time. We're seeing a lot of changes. We're seeing a lot of uncertainty, but that's where we stand today from a regulatory perspective. So we do see regulations as a catalyst for adoption. So even though we're seeing markets and physical risks becoming more apparent, we do know that in the long run, we do need regulations, because ESG reporting took off significantly after CSRD became mandatory. We saw at Coolset that 50 plus Coolset customers hadn't reported before, and now suddenly were. Mandatory rules create common standards and level the playing field. And what we're also seeing when we compare it to financial regulations is that these also started as a burden many years ago, but now it's second nature to any company to work with financial regulations. And that kind of brings us to the point of sustainability regulations. Now it's a burden, but in a couple of years, once you streamline this, it's just going to be second nature to report on it. Also, wide adoption is needed for comparability, because investors can't act on fragmented data, which is also why we've seen so many investors and big organizations call for the mandatory regulations to stay in place. And it's also an instrument, not an end. So regulations enable markets and society in making choices that they couldn't make without the data that's provided by these regulations. That was my kind of overview of the regulations and where it's going. I'm now going to give the word to Danny, who will take us through the market side of things.
Thanks, Jasper. And yes, what you will notice in the next slides is we will have some overlap with regulations, markets, and risks. So I think that's inevitable, because everything is connected from a business perspective. But you would want to start with a short poll on this one as well. And it's more about strategy. So less on the reporting, but more on the strategy side. So we'll give you a little time to answer the poll, where it goes into a scale of yes, we adapted the strategy, to no, we don't think that there will be any impact on our strategy. And then almost everyone voted, so we'll go through the details. And it's good to see that 34% already said, yes, we adapted our strategy. 31% though says we don't see the need. We hope that we will convince you a bit to start, because we think that at some point you will have an impact on your strategy. You'll see, yes, we're working on a strategy. And some people say we don't need, we do not see any expectations of impacted strategy. So let's go through 4 angles that we defined on on how you can look at strategy. Strategy has repeated itself. It's from a really more holistic perspective how strategy would be affected, with some kind of 3 underlying pillars, but also 3 separate pillars. One is resilience for your business, one is from markets perspective, and one is from the finance perspective. And we'll start with the strategy. And that's also the reason why I mentioned we think that we hope to convince you to make a strategy change, because we do expect definitely some impact. And one of this from market perspective, market focus, and how, as Jasper already mentioned, we do see more and more companies acting. So maybe you as a company don't see any impact or see a need to change. The market around you will. And it especially starts with the bigger companies. They feel the pressure from regulations. And it's not only Europe. We see Europe making a increasing impact on less regulations on sustainability. On the other hand, we see that China, of all countries that we can think of, is moving along. They see not only the need to act on sustainability, but they also make a growth business perspective from it. So what we now see currently in the market, for example, with the electric car discussion, is that a lot of European brands don't want to move. But in China, the market is moving. And if we don't change and if we don't keep up, we're going to lag behind. And we see China taking over the electric vehicle market, for example. And it's not only with electric vehicles, we see it with more and more aspect of the economy. But you also see African countries moving away from less pollution. And we do see also in South America quite some changes happening. So the market focus is driven also from a more global regulation perspective, where then the international organizations have to commit to, and they start pushing to their value chain. Because a large company cannot become more sustainable if the whole value chain doesn't change. And a lot of smaller companies are definitely in that value chain. A second perspective then is investment decisions. Sorry, if we can go back to the slide for a second. Yeah, thanks. It's from the investment perspective. So you probably make decisions for 1 to 3 years ahead, but you also will make decisions for 5 or 10 years ahead. Meaning that if you want to make solid decisions and taking what Paul will talk about later, the risks and the opportunities into account, you will have to start thinking along 10, 20 years horizon sometimes, what it can do with your business. So maybe currently, day to day, you don't expect any change, but within 5 or 10 years, we do expect a lot of change. One example is the reduction in CO2 emissions. The first really hard targets will start in 2030. That's 5 years along the line. So we see companies delaying, but 2030 with the goals that we have set, they're still set. Yes, the EU is debating a bit on that, but we cannot deny that we have to reduce. So the longer you wait, the more decisions that you currently make without any change in perspective or in foresight. Oh, I think my connection is bad, so I hope my sound at least continues. That if you wait, your decisions are made on a presumption that nothing will change, but within 5 years or 10 years, it will change a lot. And on the other hand, supply chains and site disruptions, they also will be impacted. And it's important if you make new decisions for the long term to also take those into account. And then we'll touch upon a bit on the 3 underlying pillars, with the first as resilience. And here you will see some overlap also with what Paul will talk about. But to point out 3 topics where disruptions can happen with your operations, and where it's important to build resilience. And one is more downtime. So currently, all companies from the operation side try to limit their downtime. But with increasing effects, for example, of forest fires, that can also not only affect your company, for example, because you're not in the forest fire area, but if your supply chain is going through an area where forest fires are happening, it can definitely disrupt your operation and flow of raw materials. Meaning you can and will have higher downtime. You will have to anticipate on those if you want to limit your impacts as a company. But it also can become more severe of blockage in the supply chain. We also had the example in Spain where there was a power outage of a day. An outage of a day was still able to be backed up with all the flow in the supply chain. But we heard a lot of companies talking about the fact that if that disruption would have taken 1 or maybe 2 more days, there would have been a major issue in the supply chain of all companies, even in the food industry, having issues with access to food in the more deeper areas within the country. So those things show that we are more and more susceptible for risks that are triggered by sustainability and climate-related topics. And if we can go to the market perspective, also briefly already spoke about it, but we do see that more and more large corporates are actually already pushing. Some because of the legislation change, some companies also because they just want to make an impact. We have lots of examples, and especially also in the Netherlands, which I think we can be very proud of, companies that do want to make a change, such as Tony Chocolonely. We also have Patagonia from a US perspective. They do want to make a change, and they drive a change in the market. So if you want to keep up, you still have to follow what the market perspective is doing from that part. And then the governmental push, not only from a reporting perspective, but also from a pollutive perspective. As mentioned, in Africa, we see a lot of countries reducing the plastic use of the use of single-use plastics. So that could disrupt the whole market on packaging materials. If you, and most of you will have packaging materials if you are in an industry of products, that will affect your business as well. And we do see customers becoming more critical. You do have a bit of a separation in society where some groups say, we don't want to change, we don't see the need for change, for less pollution. But even people that don't believe, and I think that's a big word, but if you have people that don't believe in climate change, you do want fresh drinking water. You don't want to live in a country where PFAS is too much in the soil, as we see in the Netherlands. And I think that's a common ground we have. We want a healthy life, meaning we have to change business as we do it, because we are impacting too much of the environment to that extent. And then from the finance perspective, Jasper also briefly mentioned it already. We do see that banks and especially insurance companies already are taking into account more and more the risks of sustainability. Paul will touch upon it a bit more in detail, but we have two topics. One of it is companies will be affected by the so-called physical risks, meaning flooding can cause an impact because your factory or your machinery will be destroyed. Heat stress will cause an issue, can cause an issue on your site. Banks see that, and that's a direct threat on the shorter term that can happen. Insurance companies, they can easily retreat and say, we're not going to insure you at some point, meaning you have to make a change in your impact on how to deal with that. Banks, they will look further along the line because they have a 30-year time span on loans often, meaning they will have to look further along 20, 30 years on the risks that can occur on the default. Meaning that they are more and more taking into account already those risks, meaning that if you are not already anticipating as a company that you will pay the price on the investment perspective. That feels a bit on the negative. On the other hand, if you do change, we see that finance institutions are willing to give you discounts on interest rates, for example. So it's also now still a opportunity to use that momentum where banks are stimulating companies to change. So those are the four aspects that we needed to talk about. If there are any questions specifically related to the topic, and I didn't see them in the question side yet, then we go to Paul.
Okay, thank you. So indeed, already a lot of preparation has been done for this part. So the climate-related effects of climate change. And indeed, what I would like to really stress is that regulation is important. It's indeed the catalyst, but it's very important also to keep in mind why we are making these regulations, because indeed we see that the climate is changing and it has a real effect on the economy and on lives and on the health of the people and planet. And that's why we're doing this. So that's very good to keep in mind. So I will immediately shift to the planetary boundaries, because that was also one of the key points that we would like to discuss in this session. So with the planetary boundaries, we have in total these planetary boundaries set by independent institutions who are measuring this every year. And what is very worrisome to see is that these planetary boundaries, which are defined as thresholds where we are no longer able to repair or reverse the effects of certain climate risks, that we are very near to these tipping points. And once you cross this tipping point of a planetary boundary, then there can be a so-called knock-on effect, or a sort of effect on an effect, which is very hard to predict and very hard to model. So then we are getting into an area which is very hard for us to even do a risk management on. And what's also very important to know is that a lot of these planetary boundaries have an effect on each other. I can go into a lot of detail on this, but I don't think we have the time for that right now. But there is good news as well, and there is some bad news, unfortunately. But the good news is that actually there are two planetary boundaries which are becoming better, which is the ozone layer, because of the Montreal Accord, and also aerosol particles in the air. So air pollution is less. That's mainly because of maritime shipping laws that has changed. So indeed, we see that the air is becoming more clean, and that's very good. Less smoke and pollution and health hazards because of that. But it's a paradox effect because aerosol loading is actually also preventing the air from heating up because of greenhouse gas emissions and the so-called albedo effect, which is the reflection of sunlight back into the space, into outer space. And because the air is not clean, actually the other effects of climate change is becoming more prominent. So it has a sort of dual effect here, which is very strange. And that's also why it's so complex to map all these effects. Also, what's very worrisome to see is that the last 10 years, the global planet have had 10 record years of temperature rise. And that 2023 was a record temperature, and that was even busted by 2024, where we had even a record of 1.6 above pre-industrial levels. So we already crossed 1 year the 1.5 threshold that we have set in the Paris Agreement. And of course, one outlier doesn't make the trend, but what you see is that the last 10 years is building up into this trend. So we are going to go into a sort of overshoot scenario. We already expected that. But the thing is that every time that we make these assumptions and these models, is that we see that we have underestimated the problem. And that's also troublesome to see. But we are still in a resilient scenario where the Earth is still able to repair itself quite well. And if we are changing our ways and are becoming climate neutral before 2050 and have better resource use, then it's still possible to go back to a situation which is resilient for the Earth and the planet and the people living on it. And that's where we should strive to. And that's a responsibility that every organization and individual should have on this planet to work towards that. So, next slide, please. So this is in Dutch, but we would like to also make it a little bit more actual. But what we see is actually that Europe is the fastest warming continent, and that's also having a direct impact on the way of life in Europe. So we see actually indeed extreme droughts, forest fires, subsidence in the Netherlands, for example, flooding in wet seasons. So there's a lot of extremes happening. And the thing is that because of climate change, it happens more frequent and it happens more severe. So there's a double effect. And organizations and companies, they need to adapt to this. So it's very important that climate change is being accounted for within your business operations, because it's a direct link to your operational risk management, and you can actually do something about this. It's not that you are a victim of the situation. You should be proactive and have a strategy in place. What Danny already stated is that companies should take this into account, because if the regulator is failing to make regulations on this, then at least the planet will say to you that you need to change it. And also, not only your own organization, also your supply chain. I will come to an example what I mean with that in the next slide, please. Where we have a real life effect. For example, the Rhine River in Western Europe. This is one of the key vital supply chains in Western Europe. And we see that the water level has been decreasing over time and for longer periods of time, and it makes it very hard or almost impossible for large cargo ships to go up and down this river. And all companies who are located next to this river have a problem with their supply chain, because they cannot anymore receive the inputs they need to produce their goods. So, for example, what we have seen is that we have a chemical company, for example, on this river. They make fertilizer. They cannot get anymore the fertilizer to be produced. and they cannot ship it anymore to the farms which need fertilizer. That creates another effect that crop loss is happening. Crop loss means that food needs to be imported from other regions, which causes greenhouse gases in itself, but also causes inequality because in parts of the world where there is less food available, people will starve. So you will see that actually because of evaporation of the waterways, it actually has a knock-on effect that creates inequality on other parts of the world. So what I want to say with this is that the effects of climate change have more catalytic effects on the rest of the world, and no one example can be seen in itself only by itself. There's a bigger world that we play in. Next slide, please. Now, I've got a question for you because this is very important. Does your organization perform ESG risk management? Okay, I see that 41% said no, but we will perform this soon. So that's good. Then at least you're actionable. And please note, Force Majeure is there to help you, so we are there. And also it's very good to see that 32% to 31% have identified these risks. There's a difference between identification of risk and mitigation of risk, but I will come to that later. It's very important that once you know what your risks are, that you are having a plan in place at least to know how to deal with these risks when these occur. Next slide, please. So climate change affects the world, and it's very important to be very straight with the definitions that are being used in the market. But climate change have several different topics. So we have climate-related risks. That's also the topic of today, where we see the risk associated with the changes of the climate, including the efforts to mitigate climate change. Then we have physical risks, which are the actual risks that happen in real life because of climate change effects. So these can be both acute or chronic. So chronic is, for example, the higher sea levels because of glaciers melting. And acute is, for example, extreme weather events where suddenly a downpour is there in a valley in Germany, for example. We also have transition risks. These are the risks more related to financial topics that we need to shift to a carbon neutral world where investment needs to be directed and capital flow needs to be directed to production cycles which don't use that much carbon or no carbon at all. And we have nature risk, and this is one that is very much overlooked always because nature actually is one of the resilient factors that is able to dampen the effects of climate change. And so far the planet has shown resilience, but if we neglect nature risk, then suddenly these resilient effects could go over the tipping point that I mentioned earlier, and then it will actually have a knock-on effect on other tipping points. So we need to keep all these things together and be aware of that. If you do a climate risk assessment, there are a couple of topics that you can cover, and you see them in the middle of the screen. But you should check all these aspects to see how your business would be stressed by it, and also how your supply chain inside out and outside in would be hit by this. That's very important. Next slide, please. So this is a risk model that we currently use within risk management for financial risks mainly. And the main thing is that there are hazards, there are things going to happen, and some of them are identified, some of them are unidentified. We don't know yet because they never have happened in the past, but that doesn't mean they can happen. There's a severity and a probability to these risks, and these together make up then the risk itself. Then you can, if you have identified those, say if you find them tolerable, yes or no. If you find it tolerable, you don't need to do anything, only document the risk and know how to act when it happens. But what we would like to recommend is that you would take mitigation actions. And there are 4 types of mitigation actions that you can take in the long run and in the short run. You can insure yourself against the risk. So if it happens, then an insurance company will pay all the damages and repair the damages. This will have some limited effects on your business operation, of course. You can change, so you can actually change your business process so that you are less affected and have less sensitivity or vulnerability to the ESG risk. You can protect yourself. So, for example, if you are next to a river, you could maybe raise a dam around your industry. I don't know. But then if it happens, then you are not affected by it. So that's a protection measure that you can do, or climate is adaptation protection. Or this may be the most severe one. You could relocate your entire factory or your business operation to another part which doesn't have these effects. So these are the 4 things that you can do to mitigate a risk right now. Next slide, please. So what I already said is that we have transition risks and physical risks, but there are also opportunities. So this climate change will also bring opportunities to become more efficient, change another energy source which is less carbon emitting, for example, change your product or improve your product so it becomes less climate affected, or use new markets and become more resilient. So never only go into the negative side of risks, but also go into the opportunity side where you have now the opportunity within the coming 25 years to really make a difference in the world. And this should be reflected in your strategy and your risk management. So you are aware and you're taking action, and this will have a financial impact. And that financial impact will both come on your income statements or your profit and loss statements and your OPEX, what Jasper already mentioned. And eventually also when you're doing investments, it will also go to your balance sheet, to your CapEx investments. And those together should always be focused on one thing, and this should be business continuity and operational risk management. If you take this into account, your organization will be financially viable and prepared for the future, because the future is going to change. This is a model that we use to see the system effects. So we have causes, effects on the environment, and effects on humans. It's a little bit small maybe, but the general principle is that we have causes, and these causes can have also feedback loops. And these causes all create global warming and climate change in itself. And the effects will eventually have an effect on the environment and on nature, which will lead to flooding, droughts, heat waves, extreme temperatures. And that will have an effect on biodiversity and on nature and on crop farming. And eventually that will have an effect on people's living in cities and in nature, because there will be less land uses, resource productivity will go down. And this could eventually lead to human migration and conflict arise. So we don't want to get into that area, of course, but there will be an effect caused by climate change, which has an effect on the environment, which will have eventually an effect on humans itself. Next slide, please. And then this slide is maybe the one that will scare us the most, but this is what will happen if we don't do anything. So if we do what we do right now, then at the moment, the damages we have on climate change is only 0.5% of global GDP, so everything that we produce in 1 year, so only 500 billion. But if we don't do anything, then in the end of this century, the effects will be $70 trillion per year on climate damage. And that is in totally 60% of global GDP. So then every year we're rebuilding half of our economy to just keep the same level of welfare. And that's not sustainable, of course. So what John F. Kennedy said in 1963, that's one of my favorite quotes, is that there is a risk and cost to action. So indeed, it's hard to swallow maybe the pill right now. But if we don't do that, then the long-range effects of uncomfortable inaction will be far higher. And last climate studies performed is that if we don't do anything right now, the cost will be 4 times higher than if we would wait of doing something right now. So we should change it now to avoid higher costs later. Next steps.
Perfect. Yeah. Thanks, Danny and Paul. I'm going to just keep this really concise so we have some time also for the Q&A. There's already some good questions coming in. So how to move forward? I think one of the most important points here is to see all of the things that we raised as interconnected. So regulations, the market, and these physical and transition-related climate risks are interconnected. You should also design policies that overlap. So data collected for compliance should also should serve investors and risk management. You should move from silos to integrated data. So you should have embedded ESG in corporate strategy, finance, procurement, and resilience planning. And also, of course, have leverage reporting as a tool. So not just to satisfy regulators, but to unlock capital, to secure supply chains, and to prepare for climate shocks. And last but not least, also to future-proof your business. By aligning all three drivers, sustainability becomes a long-term value driver and not just a reporting exercise. So essentially what we're saying here is just make sure that you could integrate all of these points, and you will unlock so much more than just kind of checking the boxes that the regulators ask you to check. But you actually unlock capital, you unlock access to kind of risk insights, which then unlocks risk management, and it just kind of opens up the door to a future-proof company. Q&A. I've seen a lot of good questions coming in, so what I'll do is I'll just kind of delegate them to either one of us. Question here. Well, I have two questions on me talking too fast and muting myself because I'm typing too loud. So I think those don't need to be discussed here. But one question from Ludo, which I will put on the screen here. How can accounting firms become more circular? What is Mazars doing to lead in the industry? Interesting question on how you're reporting on this yourself. Maybe one of you can take it.
Shall I take it? I was also trying to answer them already to prevent that we don't have time for all the Q&As. So for this one, what we did within Forbes Mazars, we, as most companies, that started with a materiality assessment 2 years ago. And that gives insights in the biggest impact topics. And for us, that's basically greenhouse gas emissions along the lines of transportation and IT and uses of cloud services, etc., but also the IT hardware. And that's where the link with circularity comes in for a company as us, where we will look into more circularity within our IT systems, within our hardware. So we don't focus too much in circularity. We don't think personally that being a front runner in circularity will help us or the industry. So we focus on those topics where the most impact is to be able to approach. And on the other hand, we spoke quite a lot about environment. We also see that for us, social is the most important one with our workforce. So along the lines of DMA, we see work pressure as one of the biggest issues in an industry as auditing. So that's something where we want to take part of to take that work pressure, to lower it, and to make the profession more fun, helping us as a whole profession. And we do have some examples in where we are being a front runner and a lead in the industry on that top part. So for each company, it's important to look at where your focus is. And if you look at our clients, those that did pause a bit on the CSRD, they did use the insights of the DMA, and they were really happy that they did the DMA, although it was an extensive process, because you can actually focus on where your biggest impacts are.
Perfect. Thanks, Danny. I think we'll answer 2 more questions. I see that we're running 2 minutes over time, but feel free to jump out. We're also going to send the recording, but I think these questions are really interesting, so I want to make sure that they get an answer. One question here from Nina. Many sustainability reports that are compiled according to unofficial standards border on greenwashing and are basically just marketing material. Do you expect banks to be able to recognize this, since such companies are not required to audit or report according to the ESRS? Really quickly, my take on this, I agree. So a lot of these reports may be adjacent to greenwashing if they don't follow any official standard or don't have kind of an internal validation process. I do think that right now we're kind of in the early stages of ESG reporting. What we're seeing is that while it might be for marketing or to check boxes, it starts the conversation throughout the whole company, and that's already a really good start. Plus, when companies do, for example, a double materiality assessment, even when it's not audited, you will establish kind of an overview of risks, which a company will probably have never done before. So even if it's not audited, you will set up a really good baseline. The question on whether banks are able to recognize this, I think that's a good question that maybe is good for one of you to answer. I've had conversations with some customers where the banks were quite lenient about extending kind of reduced rates for some KPI metrics. But yeah, maybe one of you can take this.
I will take it one. So very good question. Thank you for that one. So I've contact with banks almost on a daily basis on this very topic. And what you see is that indeed the European Commission has delegated this gatekeeper function to the banks and the insurance companies. And that plays a little bit of a burden to the banks, because what you need to have as a skill set is not a finance background, but a background in geography, chemistry, physics. So banks don't have those people working there. But there are banks who are now working on making a sort of research institute where they're able to teach the people from the business who are giving out the loans to ask these questions in advance. So when they're going to invest or loan out a sum of money, they are required to ask this question and register this also and monitor this. And banks are still very much under supervision of to avoid systemic risks. So the supervisors on the European level, like IOPA, ESMA, or the EBA, they are very much keen on getting this information and want to avoid greenwashing, of course. So what we will see is that banks will ask for these questions. They will ask you every year for these questions to be updated to see how far you are with your transition plan. I also saw a question about that one. And then eventually you get hopefully favorable financing package if you are more green than your benchmark. And if you're lagging too far behind, the bank will no longer be able to supply you with funds to invest. So then you will be cut off. So this is very important for business continuity as well, to keep that in mind.
Perfect. And I think with that, we also answered some other questions that I saw popping up here. I think for today, that's all the questions we can answer. Our email addresses are here on the screen. So if you have any more questions, feel free to reach out and we're happy to get you to help you. For now, I'd like to thank everyone for attending and for the really great questions that were asked. Thank you also, Paul and Denny, for joining me in this webinar, and hope to see you on the next webinar. Thanks, everyone.